Good evening, friends. Can you please confirm in the Q&A box whether I am audible and visible clearly? Oh, thank you very much. Very good evening, friends. At the outset, let me welcome each and every one of you for the special exam-oriented course on Indian accounting standards, exclusively for those who are appearing for certificate course on Indian accounting standards conducted by ICAI. This weekend, the examination is scheduled. I am sure all of you would have been well prepared for this examination. There are few standards which I will say they are above the standard. Standard itself is has marked its name. One such standard is the Tridev standard or a Trimurti standard, which is on financial instruments. Indian Accounting Standard number 32, Indian Accounting Standard number 107, Indian Accounting Standard number 109. The next 120 minutes, I'm going to share significant aspects with respect to financial instruments. Please pay attention. Wherever you have a question, note it down. And at the end, I'll open the floor. Maybe even in between, if you have any query, you can actually raise your hand, and maybe you can type in the Q&A box also. Good. Now, I'll be sharing with you parallelly the standard document, which also I have opened up here. Hope all these are visible to you. The 32, 107 and 109. Only one thing you have to excuse me. My voice, you have to excuse me. Maybe I could have done the session on the successive day, but I was completely out of order. So my voice alone will not be of the original tone. So maybe you have to wait for another couple of days or a week to hear my original voice. Nevertheless, I wish to complete this and hand over the session back to you with good wishes so that we get the best results. Last time in certificate course on Indian accounting standard, believe me, we had 71 pass outs. So I wish this time also we'll get, and almost everybody who attended the Pinnacle, the BIndAS Pinnacle, they cleared. So that is also I want to make a point. Good. The first question which all of you must pay attention is, I don't want to distinguish between these three standards, 32, 107 and 109. Of course, there are some fundamental difference. 32 is for presentation and 107 is for disclosure. And 109 is for classification and measurement, basically. But this subject never consider this as a three standard subject. Financial instruments, maybe the literature is quite big, I only consider it as a boon, not as a bane. Why? More the information available in standard, meaning a lot of clarity is there. Only one aspect where you need to be very clear is there are certain terminologies which are new. Don't be bogged by those new terminologies. For example, in our traditional accounting, this is modern accounting. I will only call this as modern accounting. The traditional accounting, we used to post 10% provision for doubtful debts. Have you ever questioned our teacher? Now, what is this provision for bad and doubtful debts? Why 10% you are providing? Now, why not 5%? Why not 2%? Why not 20%? Some number has been, and traditionally people have been even providing it. And this number has become an ad hoc number. The same provision for the bad and doubtful debts or whatever it is, they remove that. And scientifically you measure. If there is a money to be receivable, you are not able to receive, find out how much you are not able to receive and write it off. And right and royally you write it off. But you cannot give a name as provision for bad and doubtful debts. So they have coined a new gen accounting. So new generation accounting terminology. We can call that as credit loss. Okay, credit loss. And they have added one prefix to it. It is called as expected credit loss, naturally, because it is future. So therefore, never be carried away by these kind of terminologies. All are known to us. And I am addressing only professionals, seasoned professionals, all of you. So therefore, don't be bothered about all these terms. Financial instrument means what? This is the first point. And I have given the reference everywhere. So I will take you to the respective reference only. In India is 32. In 32, the definition is in para number 11. And that definition paragraph has 1 financial instrument, 2 financial asset, 3 financial liability, 4 equity, 5 fair value, 6 puttable instrument. That's all, only 6 definitions. Para number 11 has 6 definitions. And out of the 6 definitions, fair value is already defined in 113. So it is only a repeat. It is only a repeat definition. That means technically only 5 definitions. And out of these 5, 3 definitions, actually 4 definitions are very important. That means what is the financial instruments, what is financial asset, what is financial liability. I will give you an exercise. Take a pen and a notebook. We are all not used to it, but I will give you this exercise. Write down this financial asset definition on the right hand side. I must say left hand side. And the financial liability definition on the right hand side. For example, A, cash. Okay. Here it is A, contractual obligation. So it starts with the C. The matching is only from C. C here is contractual, right? Here is contractual obligation. So it is A, B, C, D. Here it is C and D. The C and D is here, A and B here. That's all. And exactly ulta. So if you are very clear with one definition, other definition is very clear. So first I am taking you to the financial instrument. Now look at this word instrument. So instrument means something written in paper. Okay. Instrument, something in a document. Okay. So that is, so what is instrument has not been defined anywhere. Okay. So financial instrument is any contract. Please look at this one. It is a contract. So therefore, you need to read the contract. You need to read the document to understand. Let us not go by WhatsApp. Let us not go by Google. Let us not go by any Tom, Dick and Harry's meaning. But read the contract between 2 parties. Gives rise to a financial asset of one entity, financial liability of another entity, or equity instrument of another entity. So this you need to understand very clearly. Actually, this can be divided into 2. This R you can divide into two. Financial asset of one entity and the financial liability of another entity is one batch. Or financial asset of one entity and equity instrument of another entity. I'll give an example, then I will again come to this. Okay. For example, I am an individual. I have invested 1 lakh rupees in an equity share capital. In a company. Okay. So that means I am a shareholder. So therefore, financial instrument is any contract. The contract between Gopal Krishna Ranju and a company that gives rise to a financial asset of one entity. Entity is me. For me, that equity share is the asset because I have invested. That is my document to prove that there is the investment. And equity instrument of the another entity. So for the private limited company or the limited company, they have issued me equity instrument. They have shared, maybe there are 10 lakh shares, 1 lakh is given to me as an equity. Maybe the other 9 lakh somebody else is there. Or I would not have invested in a equity share. I would have invested in a debenture. I would have invested in a bond. So then also that is a financial asset for me, because whether I invest 1 lakh in equity or 1 lakh in bond, for me, it is an asset. The money, it is in some form. Okay. It is in some asset. Okay. That is financial asset. Okay. So look at this word called financial asset. Because there is a contractual right for me to receive cash or any other financial asset from the entity. That is why, what is financial asset means I have a right to receive. Financial asset is an asset that is a cash or an equity instrument of another entity. Why the word is called equity instrument of another entity? For Gopal Krishna Raju, financial asset is the equity instrument of another entity. Okay. So that is one example of financial asset. Now with respect to the bond, it is a contractual right to receive cash. Naturally, bond, once it is matured, on the maturity date, they have to pay me back. And during the year, during the 5 years or 10-year tenure, they have to repay me with, they have to pay me with interest. So I have a right to receive cash. Okay, please understand. So, is the contract that gives rise to a financial asset of one entity for me and equity instrument of another entity, or financial asset of one for me, it is a bond, and a financial liability for another entity. What is the financial liability? For them, it is a bond. Bond in their balance sheet, where it will be, debenture, where it will be. Will it be in equity or it will be in liability? It will be in liability. Liability, whether it will be a non-current or a current, that again you have to go for it. So it is a liability for them. So please look at what is a financial liability. A contractual obligation to deliver cash. For them, it is an obligation to deliver cash to me, maybe 5 years later. Okay, good. So that is your financial instrument. So financial instrument, is it an asset or a liability? Either A or B. No, it is a contract. So financial instrument is a contract. So 1D. Good. Now come to the next one. Now slowly I will introduce the concepts and also some case studies also. Parallelly I will bring it. Okay. Parallel. So let me now take you to equity. The definition of equity. Please look at this equity definition. This is your equity definition. Very interesting. An equity instrument is any contract, because equity is also a. Now you need to appreciate one thing, very important. We were discussing fair value measurement 113. Fair value measurement 113, when we were discussing, I made one particular point. What is that? With respect to fair value measurement of own equity, 113 is applicable. With respect to fair value measurement of, I repeat, with reference to fair value measurement of equity other than own equity. That is why the word is used here. Please look at this. An equity instrument of another entity, not own. own equity instrument measurement, fair value measurement, I cannot, the prescription is not in 32-107 or 109. The prescription is in 113. So please be clear about this. Okay. Now, what is an equity instrument? They never use a word called equity share. The word share is never used at all. I am only using the word called share only as an example. It is an equity instrument. Is any contract that evidences a residual interest in the asset of an entity. They never say, no, this is only a limited company, private limited company, public limited. That's one. Nowhere the word company, limited, by shares, nothing will be there. You can apply this particular definition not only for a company, but also for a partnership firm. A partnership firm, I am giving what is called this, we give a name called what is called as capital. We say capital. Actually, it is equity capital. You are giving equity. Okay. It is any contract that evidences a residual interest in an asset. Normally, even a partnership firm, when it is dissolved, we pay everybody, and only if it is left out, then only we will distribute to the partners. Okay, the partners' equity. So it is called partners' equity. So this definition is will match every entity for your information, whether it is sole proprietor or whether it is a partnership firm or whether it is a corporate. It will match. LLP, it will match. So an equity instrument is a contract that evidences residual interest. This word residual interest is the catchword. Final, last, residue. If it is there, you take. More residue you take. Nothing means Govinda. Okay. So an equity instrument is any contract that evidences a residual interest in the entity after deducting all its liabilities. Okay. So an equity instrument is any contract that evidences a commitment in the assets. Yield in the assets, no. Surrender value in the assets, no. Residual interest. So 3B. Okay. Good. Now I'll take you to another question. I wish to keep your attention to this. Look at 18. A financial instrument is any contract. We already saw this. A financial instrument is any contract that gives rise to what? Just now we saw. A financial asset of one entity and a financial liability of another entity. Now, what is the example for this? The bond investment or a debenture investment or a loan. We would have given a loan. So if I given a loan, for me it is an advance. Gopal Krishna Raju, in my balance sheet, it will be an advance, 1 lakh given. So a financial asset of one entity. Okay. Simple we will take. Why we should take equity shares or bond or debenture? We will take loan. Okay. Loan is a financial instrument. Okay. So for me, I have given loan. It is a financial asset in my books of accounts. Financial liability in another entity. Naturally, the entity which has borrowed money from me, they will show only as a liability, loan, payable. For me, advance, receivable. So in my books of accounts, advance receivable is a financial asset. Okay. Now, if I have invested, I have not given as a loan, but I have invested as an equity. No, I don't want the loan to be repaid back. I want equity share. So they give me equity. So then for me, equity is an asset. And that side, equity instrument of another entity. Please, it is an equity instrument of another entity. So that is the catch here. They always use this term to distinguish between one equity and equity instrument of another entity. Okay. So these English, please pay attention. The finer points in the English, you pay attention, you will actually understand what it is. You know, the only minus point in financial instruments standard is people don't have patience to read the standard. I'm telling you, honestly, people don't have any patience to read the standard. They only want to watch videos. They only want to see the various, you go to YouTube's on financial instruments, hundreds of videos will be there, hundreds. Only thing is people will get confused by seeing so many, he says like this, she says like this person says like that. You know who is the final authority? The standard is the final authority. So we need to actually read the standard. So what is correct one? Financial instrument is any that gives rise to A or B. It is either A or B. Okay. So 18C. Why this either A or B? In your definition, the word is R. Look at this definition. The word is R. Okay. So either A. Now next I'll take you to what is financial asset. Now, except, this is very important wording. Now, I will take you to this word called financial asset. There are 4 sub-items in financial asset. That is A, B, C, D. And in financial liability, 2, A and B. Of course, this A and B are the mirror image of C and D of financial asset. What is C? Contractual right. C12 and A12 will be the exact mirror image. Okay. So I will go one by one. So since this question is about only financial asset, okay, let me first discuss about financial asset. Financial asset is any asset that is cash. Very good. Remember, guys, now they have only said cash. See, our Indian mentality is we always distinguish cash separate, bank separate. Cash means only what I have it in my pocket is cash. No. This is also cash. What you keep it in your bank is also cash only. Okay. So cash and cash equivalent. Okay, is a financial asset. An equity instrument of another entity, which is your investment. Okay, an equity instrument of another entity is an investment. Normally, what is an example for that? Maybe you would have invested in your subsidiary. So the subsidiary company's shares will be in your balance sheet as an equity instrument of another entity. Okay, good. Now see, a contractual right to receive cash. What is an example for this? Loan given, you have to get that money back. Sundry debtors, you have to collect the money back. So a contractual right. Why the word called contractual right? So there is an agreement. It can be oral or written. Please. The word oral or written has been discussed here because the word contract has been discussed here. It is quite interesting. Please look at this word. Para number 13. I want everybody's attention here. Okay. And para number 14. Okay. I was just discussing this previously. In this standard, entity includes individuals, partnerships, incorporated bodies, trust, government agencies. Maybe if you have been restricting your mind only to corporate, limited company, shares, equity, that this, no, it is not so. This is very, very generic. Financial instruments is very wide, very wide. And please look at 13. And here I want your attention. Contracts and thus financial instruments may take variety of forms and need not be in writing. Very, very important. Okay. So contract and contractual refer to the agreement between 2 or more parties that has clear economic consequences. The parties have little, if any, discretion to avoid, usually because agreement is enforceable by law. So that word is very sacrosanct for your information. Okay. And I will come to the other part. This standard is quite very interesting, sometimes amusing. Okay. So whenever I get bored, I read financial instruments. So just read 4 paragraphs, 5 paragraphs. And somebody told me, sir, for you if you want to get amused, you read financial instruments. For me, if I have to get sleep, I read financial instruments. Believe me, sir, within 4 minutes or 3 minutes, I get very good sleep. Because we don't understand what has been mentioned here. Because the years of research, the hours and years of research have gone into this document. So therefore, you will definitely see the quality in the material, the wordings, and the way it has been drafted. So which requires professional skill, acumen to actually crack this wordings. Good. Now, a financial asset is a cash. Very good. An equity instrument or another entity, correct. A contractual right to receive cash, correct. So that means ABC is a financial asset. Naturally, B is not a financial asset. Now, let us read one more paragraph. And then I'll come here. Please look at this. See, here they use a contract that will or may be settled. That is there. Okay. A contract that will or may be settled in entity's own equity instrument and is a non-derivative, or is the entity is or may be obliged to receive a variable number of entity's own equity instrument. Okay. Now, what is the meaning or message, or what is he conveying here? A contract that will be settled in the entity's own equity instruments and is a non-derivative for which the entity is or may be obliged to receive a variable number of entity's own equity instruments. Now, please look at this. An equity instrument of another entity. Now, here, a contract that will or may be settled in entity's own equity instrument and is a non-derivative for which an entity is or may be obliged to receive a variable number of entities' own equity instruments. Wow, very interesting. For example, there is a buyback. Okay, I am eligible to receive back my shares. So there is a contract where my shares has been already taken by another company, and by contract I have to receive back that particular shares. So into my company, a contract that will be settled in the entity's own equity instruments. Now I'll give an example. Okay, then it will be very clear. Now, what is the meaning of the entity's own equity instrument here? Refers to, for example, I have given loan to a company. Okay. Now, plain vanilla, the loan has to be settled by cash. Then it will come here. If it is in cash form here, I given a loan, then it will be settled in cash, means contract to receive cash. Good. Now, a contract that will be settled in entity's own equity instruments. Now, I have given a loan to a subsidiary. Let us presume the subsidiary has to return me that money. He is not returning. But instead, there is a contract which says, or an agreement which says, instead of returning you the money, I'll give my equity shares. I'll give the equity shares, you keep my equity. So, a contract that will or may be settled in entity's own, there is no derivative in this. Okay. Now, if you add a derivative, because the word derivative is defined in 109. So I have to go to 109 to first explain what a derivative is. Because derivative, you need to understand Trimurti, like Tridev. There is a film called Tridev. So there will be three heroes. So there are three conditions. The three conditions, all the three conditions has to be satisfied. Then only it is a derivative. Otherwise, it is not a derivative. So, a lot of thought process they have put into it to arrive at this definition. So, pay attention and then read each and every wordings in it. And whenever we are in, especially on the job, try to read some of the annual reports for you to appreciate all this. I've just opened up 1-2 annual reports here. This is Sundaram Finance Limited, latest annual report. And if you look at this annual report, you'll be quite surprised. This is the balance sheet of a finance company. Okay. This is the balance sheet of the finance company. And here, the asset starts with financial assets. Cash and cash equivalent, bank balances, derivative financial instruments. Okay. Non-financial assets. This is the BIndAS representation of a Schedule 3 balance sheet of a NBFC. Because NBFC, non-NBFC, manufacturing company, it will not be like this. Financial assets or non-financial assets. For them, that is why financial asset definitions are very important. Because their balance sheet itself is only classified like this one. Okay. So now a contract that will or may be settled entity's own equity instrument and is a non-derivative for which the entity is or may be obliged to deliver. Now come to this definition. Here, obliged to receive, obliged to deliver. Now this word is very important. Why? Because the same wording will be repeated even in financial liability, but the word will be obliged to deliver. A contract that will or may be settled in the entity's own equity instrument and is a non-derivative, for the entity is or may be obliged to deliver. That is the only word difference between financial asset and financial liability definition. That is why I asked you to write, which I did it. to get the grip on this entire financial instrument standard, it is taking time. So therefore, book by book I used to write. So I will write this side the financial asset definition, this side financial liability definition. Word by word I will match. Tack, tack, tack. Only one word is different. What is that the word? You are obliged to deliver, you are obliged to receive. That's all. That's the only word difference between these two. Similarly, each and every, a contractual right to receive will be there. Now here, a contractual obligation to deliver will be. Only that one single word alone will make it. Naturally, it is a balance sheet. One side is asset, another side is liability. Okay, good. So 17D. Now let me take you to look at this, guys. This is one thing I want to, after explaining amortized cost, I want to take you to one case study, one simple case study on what is amortized cost. Okay. So let me first take you to this 109. This is 109. Now 109, of course, it is 239 pages. 32 is 49 pages. 107 is 65 pages. Don't be bothered about by the number of pages. So put together, it will be minimum 350 pages. Okay. So don't be bothered about these numbers. Okay. So only focus on what you need to understand and appreciate. I am not taking you to the appendix A. Yes. This appendix A is your definition. And believe me, this particular definition, appendix definition, has 27 definitions previously. Last year, they have amended this Indian accounting standard. That is 2021. There was an amendment. And you know what they have amended? One of the definitions. Look at this. 30 and 31. Wow. When they have amended 18 June 2021. So now it has become 28 definitions. Okay, for your information. That means before that, what it was, only effective interest method was defined. Effective interest rate was not defined at all, for your information. But the word effective interest rate is used everywhere in the standards, everywhere in the 109 financial instruments. But what is the effective interest rate is not defined. So, effective interest rate is defined. Now, when the previous version, effective interest method definition included effective interest rate, but they have not explained what is effective interest method technically. So it was not a clarity what is effective interest method, what is effective interest rate. So I will explain this and I will take you to a exercise also. I'll solve that exercise so that you have a clarity, you will get a grip on what we are discussing. Okay. Now, look at this. This is one thing which I want to discuss, then I'll take you to the other one. Now, this is the terminology we need to first understand. Okay. Yes. This word called credit loss. Okay. Look at this Sundaram Finance also. There will be a word called credit loss. Okay. Expected credit loss. Look at this. As per 109. If you look at this definition, 109, credit loss. Where was, sorry for that. This is your appendix A. Appendix A. Yes. This is your credit loss. And I want to make one observation to all of you. When I'm defining credit loss, look at the word here. It is only loss. But moment it goes to expected credit loss, it is not expected credit loss. It is expected credit losses. Because more than one loss, you will multiply with the respective probability. Okay. So look at this expected credit losses. Okay. So that is the next one. Expected credit loss. Expected credit losses. Okay. Similarly, there is one more I want to discuss. Lifetime expected credit losses. moment they are discussing more than one loss, more than one transaction, okay, that word credit loss refers to only one transaction. So it's very, very interesting to understand. Okay, now please come to this. Okay, 11th question. As per India's 109, okay, the difference between all contractual cash flow that are due to an entity in accordance with the contract and all the cash flows that an entity expects to receive discounted at the original effective interest rate. Is this credit impaired financial asset? It looks like that. Credit loss, loss allowance, modification gain or loss. Somewhere some loss is there. Okay. See, I have given money to Krishnamurthy. 2 lakhs I have given. No, Krishnamurthy has to pay me 2 lakhs. So in my balance sheet, 2 lakhs is there. Next year balance sheet also 2 lakhs. Third year balance sheet also 2 lakhs. Now when the 2 lakhs will come? So then you are taking efforts to collect money. He says after all negotiation, he says, okay, in another 3 months time, I will pay only 1.5 lakhs, not 2 lakhs. So 50,000 Govinda. Okay. So that means what is due to an entity? 2 lakhs. What is expect to receive? 1 lakh 50. So difference is called credit impaired, credit loss. Now I'll take you to the definition. The difference between all contractual cash flow that are due to an entity, okay, and all the cash flow that an entity expects to receive, okay, discounted at the original effective interest rate, okay, discounted at the original effective interest rate is called credit loss. So that 50,000 is credit loss. That credibility, that is why we use from credit loss only the word opposite to that is called as credibility. Okay, the credibility is one who honors the payment, Okay, so Mahatma Gandhi says this. Okay, I'm not saying. Mahatma Gandhi says bankruptcy of a person doesn't start when he doesn't have money. Bankruptcy of a person starts when he fails to honor his commitment. That time itself the bankruptcy starts. So that is why the integrity, honesty, these are not the word only we have to read only in the paper and books. It has to be practiced. Maybe to say that word is easy. To practice is very difficult. That is why this credit loss in Sundaram Finance, please look at this. This credit loss, the company applies expected credit loss model for recognizing impairment loss on financial assets. Okay, and how that will be recognized in books of account, what is the journal entry and all. Once you understand what it is, all of you are professional. What to debit, what to credit, all of us know. Okay, good. So this is 11B. Next. The weighted average credit losses with respect to risk of a default occurring as the weight. Now, what is this is called? Where am I? I'm here. Okay, sorry for that. That is called as your expected credit loss. Actually, the word expected profit, expected return. So you have 4 returns. On 4 returns, you have to give weightage. For example, will you get 500 or 600 or 700? What is the weight for 500? 30%, 60%, 30%, 60%, and 10%. So then multiply and then add. That is called expected credit loss. So out of 200 or 2 lakhs, how much you will receive? 1 lakh you may receive. What is the probability for that? 1 lakh, 10%. Or you may receive 1 lakh and 50,000. What is the probability for that? 50%. So we have to only go by the scenarios. So the weighted average of the credit losses with the respective risk of a default occurring as the weight. Now credit losses. So it is not the money. 2 lakhs and you are only going to receive only 90,000. Credit losses 1 lakh 10,000. What is the probability that you will lose 1 lakh 10? 10%. So 10% of 1 lakh 10 is 11,000. Then out of 2 lakhs, you may receive 1 lakh 50,000. Okay. So that means the credit loss is 50,000. And what is the probability that you will make a loss of 50,000? Another 10%. Okay. So 10% of 50,000 is 5,000. So 11,000 plus 5,000, 16,000 is your expected credit loss. This is how you need to calculate. Okay. So weighted average means expected credit losses. Credit losses. The word is not losses. 12D. Good. Now I'm slowly going into the main subject. Now I'll take you to this first definition. Out of 28 definitions, my suggestion to you guys, for reading all the standards, read the definitions. So in India is 32, para 11 is definition, 6 definitions. In India is 109, you have 28 definitions. So 6 plus 28, 34 definitions. In India is 107. Okay, there also you have Appendix A. Okay, Appendix A. So here you have, I think 1, 2, 3, 4, 5, 6, 7, 8 definitions. Okay, so that's all. You please start with this. I am guaranteeing you that majority of your queries will be clarified by going through these definitions. Okay, good. The portion of lifetime expected credit losses that represent the expected credit losses that result from default events on a financial instruments that are possible within the 12 months after the reporting date. Now you need to understand one thing here. I'll show you the annual report of the Sundaram. Please look at this. The company applies expected credit loss. 12-month ECL represent the expected default events on the financial asset that are possible within 12 months after the reporting date. See, the reporting date is 31/3/2021. Okay, now another date is coming, 31/3/2022. Okay. Now, you have hundreds of receivables. For example, there are some 7 persons from whom you have to get the receivable. You have to get the money. The due dates are various dates. Especially Sundaram Finance means hundreds, thousands of customers will be there to receive money from them. Now, every customer, their life, their balance time to repay their loan will not be less than 12 months. Some will be 24 months, some will be 60 months, some will be another 10 years, 20 years. So how can I go for the expected credit? What will happen? So based on the track record with that particular, or the transaction with that customer, say the customer every 12 months, 3 check is bounced, only 9 check is honored. Then I have to take effort to actually collect those 3 checks. So that means their expected credit loss is not much. He is honoring, but there is a delay. So can we consider him as good or bad? I have to go by a policy. That is why these things, as an auditor, how will I audit? So Usha is my, actually she is signed this particular balance sheet of Sundaram and Srinivasan. She is my classmate, and she would have gone through that respective contract and also the transactions. So every customer, they would have gone through the transactions, or they would have divided this into buckets. So what do you call as buckets? The buckets means the entire customers will be divided into, okay, good customer, not even single default happened. Another bucket will be okay customers, like default would have happened, but they would have delayed and then made the payment. So can we consider them as good boys or bad boys? We don't know. They are good only. Okay, because as far as the books are concerned, they have not defaulted, but the track record shows they are not on time. Okay, they come and join late. That's all. So, but they are also participants. Some are there. They always 2 or 3 months they delay, and they don't honor their commitments, or at least sometimes it will happen. First year only 1 month EMI was due. Second year 2 month EMI. Third year 3 month EMI. Like that they accumulate. That means there is a risk with them. So you need to bucket the group like this, then go by. So that is what they would have discussed in this. Very interesting. So the portion of the lifetime. Now I am taking you to the definition, guys. Look at this. Now this is 109. Okay. Look at the portion of the lifetime. That itself shows, and that the portion is 12 months, representing the expected credit loss that result from default events. And even your Sundaram Finance says the same. I am not able to We are not able to judge beyond 12 months. 12 months I can do a possible expected credit loss. Possible because of the track record, based on the track record. So that is called credit risk. That wording is credit risk. And for your information, credit risk is not defined in 32 or 109. It is defined in 107. This is 107. Credit risk. See, many risks are defined here. Okay, credit risk, currency risk, liquidity risk, market risk, price risk. All these are discussed here. Okay. So this is called 12-month expected credit loss. So C, 13C. Good. Now, the expected credit loss of all possible default for the entire life. Okay, that is the definition. But practically, I cannot show you an annual report. You give me the lifetime expected credit loss. It is very difficult. Maybe they have documented it as a definition. Okay, they have documented it as a definition. Look at this, lifetime expected credit loss. So that is a separate definition. Lifetime expected credit loss. The expected credit loss, the result from all possible defaults, events, or the expected life of a financial instrument. Is it possible to calculate is a question if I put in debate. Only a short-term life, I will do it. Long-term life, I can't do it. So these are some of the assumptions. So in key audit matters, it would have been mentioned very clearly. So look at the credit loss. In the key audit matters, the auditor would have mentioned it. Look at this. Look at this is key audit matters. So here, the management judgment in the calculation of impairment losses have significant impact. The estimates regarding are complex and require a significant degree of judgment. So this and all, how can we audit? That is what Usha has mentioned it. Okay, good. So that is your lifetime expected credit loss. So 14A. Next, I'll take. Now this is your. I'm now slowly going into the main part. Okay, the risk that one party to a financial instrument will cause a financial loss to other party by failing to discharge an obligation. Now I'm taking you to 107. So this is your 107 credit risk. Okay, again I'll take you to appendix A. This is your credit risk. Now what is your credit risk? Look at this wording. Risk that one party to a financial instrument will cause a financial loss to the other party. This itself is done. Hey, I have given a loan of 1 lakh to Krishnamurthy. Now Krishnamurthy is not paying me 20,000, 80,000 he pays. So the risk of one party will cause a financial loss by failing to discharge an obligation. Is that liquidity? No. Currency or credit? What the credit I have given? 1 lakh. What is the obligation he will honor? Not 1 lakh. He will only honor me some X rupees. So credit risk is there. Now you have to quantify that. So that is the credit loss. From credit risk, if credit risk is there, credit loss will be there. If credit loss is there, you have to measure the credit loss. And measurement of credit loss is expected credit loss. And the measurement of expected credit loss, you will only do it for how many? Will you do it for lifetime or will you do it for 12 months? It all depends upon the business. Good. So that is your 15D. Good. Now next. Now I'll take you to market risk. Please understand, guys. The credit risk is between two parties. Giver, receiver, borrower, lender. That's all. So it has nothing to do with the market. There is no external factors that will affect the credit risk. It is only between two parties. So market risk are external. Okay. Example, your currency risk. That means your Australian dollar to INR, Singapore dollar to INR, US dollar to INR. Okay. So Saudi Riyal to INR. So these are all these are all exposed to fluctuations. Okay. So there were the fluctuations is there. Currency risk, interest rate risk, and price risk, other price risk. Okay. Some product prices will go up. That will have an impact on my price. My price also will go up or it will come down demand will be more. So that is called market risk. Because of the impact of the other price, my product will never be available, or it will be a demand, or price will go up, something. So market risk consists of three types. No, it is not credit risk. Credit risk is non-market risk. So credit risk is non-market risk. Currency risk is market. Interest rate is market. Price risk is market. Credit risk is non-market. So except means non-market. So 16A. Okay. Well, now let me take you to, I'm not going into depth of the subject. Okay, depth of the subject. Now, please look at the BIndAS 32, para number 15. I will take. This is a very important paragraph, and maybe I have to take you to the first para. Look at this first para. See, this paragraph, of course, para 1 has actually been deleted. So to have in sync with IAS 32, BIndAS 32, to have in sync, certain paragraphs are not in sync with the preface of the Indian accounting standards. So therefore, carve out would have been done. These are all carve out. What is called carve out? When you go to on a Vinayaka temple, on a Ganapati Chaturthi day, you go to market to bring God, to bring Ganapati home. What type of Ganapati you will bring? The clay Ganapati you will bring. In the clay Ganapati, it is very nice. Okay, it's very nice to see a God in clay form. So they will have some model, and that they will put the clay, and then the Ganapati will be there. To make Ganapati more lively, they will carve out some of the clay so that the shape of the Ganapati will be nice to see. Number one. Number two, they will carve in. What is carve in? To more beautify, they will take some ice, red and black color. They'll keep the ice in the Ganpati. So that is called carve in. Like that, some of the paragraphs will be carved in. What is carved in? That you will not see there. What is carved out? The para 1 is carved out. So to beautify this to Indian requirement. Then only it will look like a beautiful Ganapati. Okay. Carve in is, I will further basify it. So some of the paragraph will be 2A, 3A, 3AA, 4AA. These are will be there. So those are all basified paragraphs, which will not be there in your international financial reporting standards. So carve in will be missing there. Carve out will be missing here. Please understand. What is carved into BIndAS will not be there in IFRS. What is carved out here will be available in IFRS. What is carved in BIndAS will not be available in IFRS. So please understand that. So with Ganapati, you can actually appreciate what I'm saying. Now I'll take you to, now why I'm mentioning this particular para is, the objective of this para standard is to establish principle, etc. All this. It applies to classification from the perspective of the issuer. This word is very important. This word is very important. Now, all this blah, 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 I'm doing this, I'm doing the presentation, measurement, all this Lotulos and all I'm doing. But from whose perspective, in whose books of accounts it is? It is from the perspective of the issuer. Now, who's an issuer? Maybe if I'm issuing equity in my books of account, if I'm issuing preference shares in my books of account, if I'm issuing a loan in my books of accounts, if I'm giving loan in my books of accounts. So issuer. Okay. So it applies to the classification of the financial instrument. This word classification is very important, guys. Okay. Classification. So this entire concept is actually, I'll call it as PM, classification measurement. So please wait. I'm going into this main standard. At that time, I'll bring the case studies and all. Okay. Now, please come to this para 15. Look at para 15. I should have taken to para 15 straight away. This is your para 15. Para 15 says, yes, the issuer of a financial instrument shall classify the instrument. This is the first step. Now you need to classify. What is classification? I'll go to 109. 109 actually explains how to classify. Okay. And for your information, Reserve Bank of India site, this is Reserve Bank of India's latest site. They have actually released a discussion paper on classification, valuation, operations of investment portfolio of commercial banks. So this is your paper. Okay, discussion paper. Look at this is a discussion paper. In this discussion paper, the investment portfolio shall be categorized into 3 categories. Look at this. Held to maturity, available for sale, and fair value through profit and loss account. For your kind information, so far, Indian accounting standard is not applicable for the banks, insurance companies. Okay, they are not applicable. But now, indirectly, through Reserve Bank of India's discussion paper, they are reviewing the prudential norms of investment portfolio of commercial banks. And this will be applicable from 2023 onwards. Now, why they are giving the notification in 22? Because in 22-23, that will be a comparative figure when it is applied for 23-24, because it is applicable only from 1/4/23 onwards. They have mentioned it very clearly. Okay, but why they are mentioning this particular framework? Please appreciate this. Rather than nowhere they say that BIndAS is applicable. And for your kind information, the particular discussion what they have mentioned, please look at this. Classification, initial recognition, subsequent measurement, reclassification, limits, non-SLR in HTM, held to maturity, valuation. If you look at this 4 paragraphs, these are discussed, whatever they have prescribed in this particular discussion paper is nothing but the BIndAS prescription only. I repeat, it is BIndAS prescription only. So already Reserve Bank of India, indirectly they are advocating the Indian accounting standards to banks through this discussion paper in a soft mode, so that once this is implemented by all banks, then maybe the major part, the what you called as this is called the investment portfolio. Very, very important area. See, the money which is handled by the bank by investing or keeping it till maturity or holding it for sale. Okay, HFS. So all this matters a lot for banks. And when you bring the Indian accounting standard prescription in the form of a prudential norms, very easy for banks to actually migrate to BIndAS, because this is the only big area where BIndAS will be a big challenge for them. Will be a challenge for them. Will be implemented. And after that, implementing BIndAS in banks is going to be very easy, because so far the Indian accounting standard implementation for banks and insurance companies is fine time. Okay, so they are now opening it up. So look at this. I was here. 15, para 15. Sorry, where is this? The issuer of a financial instrument shall classify the instruments or its parts on initial recognition of a financial liability, asset or equity in accordance with the substance of the contract. So, who the financial instrument will classify the instrument, the holder of the instrument or the issuer of the instrument, or either the holder or the issuer of the instrument shall classify the instrument or its component parts as a financial liability or asset based on the substance of the contractual and the definition. This is the meaning, and that is the paragraph I referred to in para 2 also. In para 2, the objective itself they mentioned this standard is written only for the issuer. So you need not worry about holder at all. Okay, only issuer. So 19A. Now slowly I'm going to examples and case studies. Okay. Financial assets representing a contractual right to receive cash in future or deposits made, you have to receive the money. So that means you have a right to receive cash in future. So A is a financial asset. Investments in bond. So on maturity, you have a right to receive the money. Trade accounts receivable. So on maturity, on the due date, you are eligible to receive the money. So ABC are financial assets. Loan and notes payable are contractual obligation to deliver cash. The wordings will be contractual obligation to deliver cash. That is called financial liability. So D is a financial liability. So D is not the answer. D is not a financial asset, but D is the answer here. So 20D. Now I'm taking you to another interesting paragraph. Yes. Okay. Come to this. This is actually application guidance. My suggestion to you is read the Appendix A, which is the definition, and Appendix B. Appendix B of IndAS 109 is bigger than the standard itself for only one reason, because the Appendix B is an application guidance of the standard with examples they have discussed there. So by looking at the pages and the numbers and the technical words, people take a backstage. Please don't do that. Aram say, please read. You will definitely enjoy reading this particular standard. Okay. Now, I'm taking you to perpetual debt instrument. Now, I'm going into one point called classification. Now, I'll put a simple question. Equity capital will be in equity. Debentures, bonds, or preference shares. Preference shares, will it be in equity or will it be in liability? Preference shares, is it equity or liability? Maybe our teacher would have taught. I'm not here. I'm not a teacher here. Okay. I am a professional giving before you what the prescription of the standard is. Okay. So maybe teachers would have taught us. No. Preference share capital is given by preference shareholders. They are also shareholders. Shareholder means owner. So therefore, it will go to equity. So it has been only given as a explanation. Okay. Now we are going to analyze, and because when you have to present it, when you have to the wordings, please look at the standard, guys. It's very, very interesting word they have used. Financial instruments disclosures, financial instrument presentation. IndAS 32 is financial instrument presentation. IndAS 107 is financial instruments disclosures. And IndAS 109 is financial instruments classification and measurement. Okay. So let me now take you to this perpetual debt instrument. Now, what is perpetual debt instrument? Simple. I'm a company, I'm an issuer, I'm issuing perpetual debt. Means what? I'll take loan. Say 1 crore, I'll take loan, but I will not pay 1 crore. I will not repay 1 crore at all in lifetime. Till your death, I will not pay. Then what I will pay? I will only pay vatti. I will only pay interest. So, very interesting. For me, perpetual debt instrument is, for the holder, it is a financial asset. I invest 1 lakh. 10% means yearly I'll get 10,000, 10,000, 10,000, 10,000. Invested 1 lakh. So that means it is a financial asset. So from a holder perspective, it is easy. But the standard is not written for holder. It is written for the issuer. So issuer, from an issuer perspective, it is a financial liability. Why? They explain this in big paragraph. ultimately you have taken loan, but what is that you are repaying? You are only repaying only interest. So please understand that normally provide the holder the contractual right to receive payment on account of interest at a fixed date extending into indefinite future. For indefinite future, not infinite. Infinite is different from indefinite. Okay. In the entire Indian accounting standard, the word infinite is not used. Only indefinite is used. Even in Indian accounting standard 38, intangible assets, the word is indefinite, not infinite, for your information. Okay. So normally provide the holder with the contractual right to receive payments on account of interest at future dates extending into indefinite future, either with no right to receive, okay, under terms that may likely or very likely in the future, which may change. Okay. It will not change. So always only interest alone will be paid. So therefore, the perpetual debt instrument is only a liability for me to pay interest. Okay. So it will be liability. So it can never be there is no model to actually treat that as a equity at all. Maybe if I'm not, sometimes the debt will be a convertible. So convertible debenture, convertible bond, all this will come. So when convertible debenture or bond is coming, till what time you are going to consider, till what time you have promised, till what time you have actually committed. Okay, that contract you have committed, I'm not going to convert into equity. For example, it is convertible bond, 5 years. Okay, 5 years convertible bond means for 5 years I will only pay interest. Only once that the 5th year line crosses, the obligation for me to convert that bond paper to an equity paper. So till the 5th year, it will be classified as a liability. Once the date crosses, you have to reclassify that liability into an equity because you are obligated to issue equity. You have already, that is your contract. So you need to read the contract. That is the objective of this entire standard. So now come to this. So perpetual debt instrument normally provide the holder the contractual right to receive payment on account of interest at future dates extending into indefinite future, either with no right to receive a return on principal or right to a return of principal under terms that make it very unlikely to very far in future. Hence, the issuer of the instrument have a financial liability. The holder has a financial asset. Okay, issuer have a financial liability. So 21B. Okay, good. Now, redeemable preferences. Now, this is from holder. Look at this. The same question, I will twist it from a issuer perspective. Now, I'll take you to another paragraph. So maybe I missed this. AG 25. Okay, application guidance 25. Okay, look at this. This is your preference shares. Whether preference shares is a equity or a liability. Okay, preference shares may be issued with various rights. Please understand this. This entire paragraph is very, very important. Okay. Now, in determining whether a preference share is a financial liability or an equity, an issuer assesses the rights attached to the share to determine whether it exhibits the fundamental character of a financial liability. So you need to read because preference shares are various models of preference shares are there. Okay. For example, a preference share that provides for redemption on a specific date or the option of the holder contains the liability because the issuer has an obligation to transfer the financial assets to the holder of the share. The potential inability of the issuer to satisfy an obligation to redeem a preference share when contractually required to do so, whether lack of funds or statutory restriction or insufficient profit does not negate the obligation. Now, what is the meaning? Now, the preference shares, now I'll give you a classic example. An option of the issuer to redeem the shares for cash does not satisfy the definition of a financial liability because the issuer does not have a present obligation to transfer financial assets to the shareholders. Now, what is the meaning here? Redemption of the share is solely at the discretion of the issuer, or redemption of the shares is solely at the discretion of the holder. This is where the catch is. Okay. Who has the right to redeem the shares? Okay. Now, I'll read this paragraph once again. An option of the issuer, that means the company, to redeem the shares for cash does not satisfy the definition of a financial liability, because anytime I can redeem it. Okay, the option of the issuer to redeem the shares for cash does not satisfy the definition of the financial liability because the issuer does not have a present obligation to transfer the financial asset to the shareholders. So, for example, I am issuing preference shares. I say I will repay the money when I want to repay. So look at this, when I want to repay. So that means I have not decided this year, I will not decide next year, I will not decide third year also. So 3 years I have not decided I am going to pay. If I am not going to pay for 3 years, is it a liability? Why should I show as a liability? Understand that. That concept, please understand. Okay. Now, 4th year I am deciding, no, I don't want, I want to offload all this here. Let us pay. We have money. We will have equity and then enjoy. We'll pay all this tukada, kikada and all we'll pay. So, 4th year I have decided to redeem these guys. So, I will call, come from this month to this month, I am going to redeem. So, those who are coming, I am going to pay. So, then in my balance sheet, that will be treated as a liability. So, please understand. An obligation may arise, however, when the issuer of the shares exercises its option, usually by formally notifying the shareholders of an intention to redeem the shares. Okay, so that is most important. Sometimes the option would have been given to the holder. So option would have been given to holder. Now answer this question. Redeemable preference shares, redemption at the specified date, or at the option of the holder. Or at the option of the holder. So now, please answer this question. Now, holder, anytime he can ask, I don't know, I have issued preference shares. Anytime he can come and ask me, because the time limit is 5 years. Maybe lock-in period 1 year. This lock-in period 1 year, and post 1 year, what is the, and first 1 year, what you will disclose? How will you actually record that? How will you actually classify it? How will you actually classify it? So it all depends upon, because the right is not with the issuer, right is with the holder. And holder, once 1 year lock-in period is over, he may ask any time. So therefore, it is a liability. It is a liability. Okay. But if the option is at the issuer, then I know, because I am only writing the balance sheet, my balance sheet. So the management has to say, when auditor is asking, yeah, you have disclosed it as a equity or you are disclosing as a liability. What is why you are disclosing as a liability? No, sir, this year we are going to pay. No, why you are disclosing as an equity? No, sir, next 3 years we are not going to pay. Please understand. Okay. So that is the paragraph here. Liability and equity. No contractual obligation to deliver cash on another financial asset will make it equity. If you have an obligation to deliver, okay, cash, or in lieu of cash you are giving any other financial asset, then it will be a liability. Simple, matter over. So 22B. Now come to this. This is from issuer perspective. Now please apply your mind. Okay, same paragraph. Now I'm not going to explain this because I already explained. When distributions to holder of the preference shares, whether cumulative or non-cumulative, are the discretion of the issuer, the preference shares are equity. Okay, the preference shares are equity because it is the discretion of the issuer. Until I decide, I have to redeem it. For example, when distribution to holders, whether cumulative or non-cumulative, are the discretion. Now, these wordings are very important. I am not going to redeem. Okay. I am only going to this interest, whether I am accumulating or non-accumulating. Non-accumulating, I will distribute to them. So whether when distributions to holder of the preference shares, whether cumulative or non-cumulative, or the discretion of the issuer, so I have to decide. Until such a time, it is only equity. So when I have decided that no, this accumulation we will pay, that portion alone I will show it as a liability. Remaining portion will be equity. So please be very clear about it. Okay. So you need to read the contract. You need to understand what is the commitment given, conditions. Good. Now, derivatives are generally measured at. Now, slowly I'm coming into the subject. Okay. Now, 109. This is your 109. Okay. I'll take you to paragraph number 5.11. Because look at 5.11. This is your first para number 5.11. Initial measurement. Okay, good. Look at this. So, and also I will take you to para number 4.1.4 also I'll take. I think that one paragraph is sufficient. A financial asset shall be measured at fair value. Okay, fair value through profit and loss account. Okay, unless it is measured at amortized cost with respect to para 4.12 or fair value through other comprehensive income. This I am going to explain now. Okay, so financial asset shall be measured at any of the two methods. I will please look at this cost here. 4.1.1. An entity shall classify financial asset subsequently measured at amortized cost or fair value. Fair value which will be impacted in your balance sheet, that is another comprehensive income, or it will be impacting your P&L account. Now, when it will impact your other comprehensive income, when it will impact your P&L, please wait for some time. Okay. So, financial asset is subsequently measured at. Now, I wish to share with you one interesting point here. This entire standard, you can call it as CM standard. Okay. What is called a CM standard? Okay. Financial instrument 109 is called CM. Why it is called CM? Classification and measurement. First classification, then only measurement. No, I will do the measurement, then I will classify. No. Please decide whether it will be financial asset, okay, or financial liability. If it is financial liability, where you are going to present. Presentation go to 10. Your 32 will speak about presentation. Okay. Classification 109. Presentation 32. Okay. Please understand. So you have to first be very clear about classification, then only measurement. That is why the wordings that is used is called subsequently measured. Please look at this wording. Para number 4. The wordings is entity shall classify the financial asset subsequently measured. Okay. Good. So now derivatives are generally measured at no cost, no market value. Okay, there is only 3 terminologies. What is called amortized cost, fair value through profit and loss, fair value through other comprehensive income. Now, what is the meaning of this? We are going to understand one by one. So there is no recognition, no disclosure and all wrong. Cost is wrong. Amortized cost is correct. So there's only matching with respect to 109 prescription is fair value. So 24B. Okay, good. Now come to this. Preference shares are classified. We already know this. Preference shares are classified as equity, as liability, or based on legal or contractual terms. Okay. So it is equity or liability based on the contractual terms only. So unless and otherwise you read, understand what is the commitment you are given, who has the right, whether a holder has the right to actually ask for the redemption or payment or accumulation, non-accumulation. So, or issuer has the right. You need to read that. So 25C. It is not equity or liability. Maybe if example is given, we can read that example, understand what is the condition, then we can say, okay, it will be liability or an equity from an issuer perspective. Okay, good. Now, which of these are financial assets? Okay, which of these are financial assets? Now, I'll come to this after I explain to you the amortized cost. This is very important. Now, amortized cost example I have to do. One case study I will do slowly. Okay. Now, this is the para already I read. This is very important. Okay. I have given this in the end also for your kind information. Look at the end. This is financial asset. Entire definition I have given. Financial liability I have given. And look at this. Financial assets. Now I'm going to show you this. Yes. This paragraph is what is here. Okay. This paragraph is here. Financial assets. An entity shall classify financial assets. Subsequently measure that. How will you measure it? Amortized cost or fair value through other comprehensive income or fair value through PL. I'm going to explain each one of this now. Okay. So at amortized cost, fair value through other comprehensive income based on both. What is the both? They are given this. So two conditions. Okay. So please wait. Let me now take one by one, unravel one by one. What is amortized cost alone? I will unravel it. Okay. Then the concept of accounting in amortized cost, let me explain. Examples I will give with respect to amortized cost. And maybe if I explain out of these two, because FETPL is residual category. Out of 1, 2, 3, if I explain 1 and 2, third is the balance part. Okay. And I want to make one observation here that please read this Reserve Bank of India's, look at this discussion. I will take example from Reserve Bank of India. The investment portfolio shall be categorized. Okay, categorized means classified into 3 categories. Held to maturity, okay, HTM, available for sale, fair value through PL. Wow. Okay, look at this. It's held to maturity, amortized cost. What is called as amortized cost? I'll explain. Okay, this held to maturity is what is the business model test we are going to understand now. Okay, look at this. Yes. So they are given 2 conditions. What is it? The entity's business model for managing the financial assets, contractual cash flows. Let me explain this. Okay. So now answer this first 2 questions. And after that, I'll go one by one. Then I'll introduce some of the questions also. An entity shall classify financial asset, then only subsequently you have to measure. First classification. Except amortized cost is one method. Fair value is another method. Fair value through comprehensive income is one method. Through P&L account. Comprehensive income is your balance sheet reserves and surplus side through P&L account. Okay. So I will explain these 3. And practically I have given the example of Reserve Bank of India's classification. How the banks, because the biggest portfolio, even corporates may not have. Corporates may not have big portfolios. The big portfolios are only banks will have. And so far, BIndAS is not applicable for your kind information. Okay. Now, 6th question. An entity shall classify amortized cost, fair value through comprehensive, fair value, carrying cost is no wrong. Okay. This is something belonging to your material costing and all. So 6D. 6D is a wrong answer, that's your right answer. An entity shall classify financial asset as subsequently measured at amortized cost, fair value through other comprehensive income or fair value through PL on the basis of. Now, don't be bothered about, I will explain this amortized cost with an example now. Okay. Don't be bothered about this fair value through other comprehensive income. Meaning, You buy a particular investment at the market value, and today, what is the date? Today's date is 28th of January 2022. Okay, you buy at market value. Market value is fair value. Now, the end of 31st March, market value will be different. It will go down or come up. So now you invested 10 lakhs. 31st March, 10 lakhs has become 7 lakhs. So loss is 3 lakhs. Now this last 3 lakhs, will you book in P&L or will you show in balance sheet and other comprehensive income? This is the question. So this 3 lakhs you have to show it as a loss. But where? That depends upon two things. That is what it is. Okay. What is it? Entity business model and the contractual cash flows. Okay. Now I want to bring your kind attention. Based on this, both the conditions, your entity's business model and contractual cash flows. I'll explain what is this. Okay. One by one with the example. One by one, I'll give the example because I want to show you the examples question. But let me give the definition of the classification. Then I'll go to example so that you can catch the information quite easily. So both the points, business model and contractual cash flow. So both I'll explain with some examples now. So 7D. Okay, good. Now I'm taking you to one interesting question. Let me take you to a question now. Okay. Amortized cost I will take because it's effective interest rate method and all. Let me explain. Amortized cost, I have given you the name. I'm going to explain that with one example here. Okay. And effective interest rate also, let me explain it so that we are clear with all. So I'll take you to Appendix A. This is your Appendix A. Now here, for the first time, guys, from 2021, they have, this is the amendment they have made to the IndAS 109. Okay. Effective interest rate they have defined here. Now, because I'm going to do one example on that. So please answer this question. Yes. Now, effective interest rate. What is it? See, you borrow money. Okay, I want to borrow housing loan, or I want to take some personal loan. Okay, simple personal loan will take. Simple personal loan is you borrow, you have to repay. But in personal loan, you know how it is, the business is done. Okay, how business is done. I'll take the loan, say, let it say 12 months EMI, 1 lakh. 1 lakh EMI, 12 months. So that means I have to repay 12,000 rupees, let us say, assume. So 12 into 12, 1 lakh 44 I have to pay. He will give me 1 lakh loan. Okay. This concept of first EMI, what they will do, EMI they will subtract it. They'll take. So that means 1 lakh they will give, 12 lakh, 12,000 they'll subtract. So they will give me effectively 88,000. So meaning he gives me 88, but he takes from me 12 into 11, 1 lakh 32. Okay, 1 lakh. So he gives me 88 but takes 1 lakh 32. So therefore, is my interest rate 12%? No. The effective interest rate is high. Apart from that, there will be legal charges, documentation, that, this, and all, everything will be paid initially. So therefore, you need to factor these costs in the interest rate and find out the effective interest rate. Now that is your definition. The rate that exactly discounts estimated future cash payments through the expected life of the financial asset to the gross carrying amount of the financial asset. What I receive, what I pay. What is the gross carrying amount or to the amortized cost of a financial liability? So that rate is called an effective interest rate. So what is your net I receive? What is the cash flows I give? So connect between these two and your effective interest rate. Otherwise, your future cash flow discounted, you will get what you get in hand, 88,000. What you pay is 1 lakh 32. for your information. So what is it hedge ratio, effective interest method, effective interest rate, loan commitment. Now, this effective interest method is the method that is used in the calculation of the amortized cost of a financial asset or a liability in the allocation and recognition of the interest revenue or interest expense in the profit and loss account over the relevant period. That is called effective interest rate. So naturally, whatever the documentation charges, you are going to expense to P&L account. But as a effective interest rate, the method that is used in arithmetic calculation is the calculation of the amortized costs in a financial asset or a liability. So we'll do that one. So what is the calculation of the amortized cost of financial asset in the allocation and recognition of interest revenue is called effective interest method. So 9B. Okay. 9B. What is effective interest rate and effective interest method? Okay. Please have a fundamental difference. And for your kind information, this has been amended in 2021, June 18, 2021. Now, before June 18, 2021, effective interest rate was not defined. What was defined was only effective interest method was only defined. What is effective interest rate? They have not defined it. Okay. So they are giving all those things. The calculation includes all fees, points received between the parties, transaction cost, premium. So all these you have to factor it. Okay, so that is what they mean about effective interest rate. Now let me do one question. Okay, now look at this, guys. I'll take one. All these I have done. I will come to this 26, 27 and all I will come. Let me do one arithmetic on this effective interest method. Using effective interest rate method, calculate initial amount amortized to be recognized if the future year-end cash payments are 10 lakhs for the next 3 years at 10%. So effective interest is given. Now, there will be another question. So you need to do various arithmetic to actually understand this concept. So one particular arithmetic, I will give one case study to calculate effective interest rate alone. Here, effective interest rate is given. You have to find the amortized cost. Okay. Once amortized cost is known, then journal entry. Journal entry and all I am not going to discuss. All of you are very good at it. Okay. But I'll only explain the logic here. So now I am going to take you to the definition of amortized. Calculate the amortized cost. So the definition of amortized cost I will take. What is called amortized cost? Okay. So you have should not get. So let me do that question. So where is that? It is here. So let me do that. This is here. How many years? 3 years. If the future year-end cash payments are 10 lakhs. Okay. So 1, 2, 3. Okay. So 1, 2, 3. And your future year-end cash payments are 10 lakhs. So your cash outflow. So what do you pay is 10 lakhs. Yes. Now your effective interest rate is 10%. So discount at 10%. 1 divided by 1 plus R. That's all. So this is your present value factor. So what is your present value? Okay. So your present value is this. So what is your total? Your amortized cost. This is your amortized cost. So what you pay is 30 lakhs. Okay. And what you will recognize. So this is your liability. So now come to this question. Using effective interest rate method, calculate the initial amount to be recognized if the future year-end cash payments are 10 lakhs. So even though your liability is 30 lakhs, what is recognized books of accounts is only 24. Your total liability is 30, but you will not. Normally, in the traditional method is 10 lakhs will be accounted every year. But in India's 109, you record 24 lakhs 86,851.99 in year 0 itself. So now what I will do, this is year 0 beginning, opening balance. Okay, interest, total, payments, closing balance. Okay, so your opening balance is 24. Your interest is on this 10%. So sorry. So your total is this plus this interest is, your payment is 10 lakhs. So what is your closing balance? 27 lakhs minus 10 lakhs. So this is your interest portion. This is your interest. First year interest. Now second year opening balance is this. On this interest payment will be on this interest payment. So your 17 lakhs plus 1 lakh 73. Payment what you make is 10 lakhs. Your closing balance is 9 lakhs. So on 9 lakhs, again you have to calculate the interest. This is you pay 10 lakhs. That's all went wrong. So you will recognize this 24 lakhs as your liability. Okay, your liability in your books of accounts, your liability will be 24 lakhs 86,851.99. Okay, so using effective interest method. Good. And interest, you will end of the year you will add interest, debit your Pinnacle account, credit your outstanding balance. Payments as you make, your liability will get reduced. At the end, the liability will become 0. That's all. Okay. Now answer this question. So if the future year-end payments are 10 lakhs, calculate the initial amount to be amortized 24 lakhs, 86,000. So 29C. Okay. Now, same question, I'll just twist it. Look at 32. Using effective interest method, calculate the third year interest to be amortized if the future year-end cash payments are 10 lakhs for the next 3 years at 10%. Okay. So it is 2,48,000 is for first year. 73,000 is for second year. 90,000 is for third year. So he is asking what will be your third year interest to be amortized. So 90,000 only will amortize. Okay. So that is 32nd question. No? 32nd C. 32C. Good. Now, one by one, I will introduce the concepts and then let us strengthen our understanding. Okay. In each and every terminologies. Now, I am taking you to the next interesting concept. Okay. I think these things we can understand. I already explained this to you. Once again, this is 107. I'll again take you to appendix here. Yes. Now, please look at this. The 3 market risk what we have seen: currency risk, interest rate risk, and price risk. Now, what is currency risk? If the risk in the fair value of the future cash flow, which will fluctuate because of change in forex rate. Fluctuation because of change in forex rate is currency rate risk. Fluctuation because in the change in interest rate, market interest rate is called interest rate risk. Okay. Similarly, other price risk is fluctuation because of the changes in the other market prices. That is called other prices. Now answer this question. The risk that the fair value or future cash flows of a financial instrument will fluctuate because of changes in forex rates are liquidity, currency. So 30B. The risk that the fair value or future cash flows of a financial instrument will fluctuate because of changes in market prices. Market prices is called, look at this. Because of the market price is called other price risk. Okay. So market risk that the fair value of future cash flow financial will fluctuate because of the changes in market prices. Okay. So that is your market risk. So 31T. But your other price risk, you have to be very careful. The risk that the fair value or future cash flows of a financial instrument will fluctuate because of changes in market prices other than those arising from interest rate or currency risk. So that is called, you have to be very specific because market risk consists of all three. Other than interest rate and currency risk, we call it as other price. This is a residual. Okay, that's a residue. So you have to be very careful with the question. So 31C. Now let me take you to some more examples. Okay. So this is one case study I want to explain with respect to amortized cost once again. Okay, and I will take you to this particular question, guys. Which of the following would not meet the definition of financial instruments? So I think now all of you must be very clear with these terms. What is a financial asset? What is a financial liability? And what will not be a financial asset and a liability? That is most important. So generally, question will be only negative question. What is not? Okay. So let us go by this. So you have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 examples are given. And out of this 10 examples, 5 are financial instruments, 5 are non-financial instruments. Okay. Now, cash deposited, financial instruments. Okay. So A is a financial instrument. Gold deposited. Will you get anything in? No. So that definition of financial asset, because deposit means it should satisfy the definition of financial asset. Now, please, what is financial asset here? Look at this. Cash, equity instrument, another entity, no. Right to receive cash, no. Or will you receive any financial asset? No. It is gold. Gold you will only receive as gold. Or gold deposited in banks, you will get only gold. The gold deposited in banks, you will only get gold back. So B is not a financial instrument. Trade accounts receivable, you will get in cash because once you invoke, you have to make payment, or on the due date you are asking, you remind for payment. You have the right to actually receive payment. So C is actually a financial instrument. A and C are financial instrument. B is not a financial instrument. Okay. Investment in debt instrument. You have the right to receive interest. You have the right to receive the debt on redemption. So therefore, D is a financial instrument. Okay. Investment in equity instrument. Yes. E is also a financial instrument. Okay. D and E. Prepaid expenses. Do you have any right to receive back? No. Prepaid, you don't have a right. That is why it is called miscellaneous expenditure, or to the extent not written off. We'll say miscellaneous expenses to the extent not written off. Okay. So F is not a financial instrument. Okay. Then G, intercorporate loans and deposits. You have the right to receive back. Okay. You have the right to receive back. You can demand the loan and deposit to be repaid. So G is also a financial instrument. So A is a financial instrument, C is a financial instrument, trade receivable, D is a financial instrument, investment in debt instruments, E is a financial instrument, investment in equity instrument, G is a financial instrument, intercorporate loans and deposits is a financial instrument, prepaid expenses not a financial instrument, deferred revenue not a financial instrument. So H is not a financial instrument, deferred revenue. Where is the question of right to receive? Statutory tax and liabilities. You are obligated to pay, okay, because of the obligation under the act, under the respective tax laws. Now look at the definition of financial liability for your kind information. This is your 32. In 32, look at the definition of financial liability. A contract to deliver cash. Okay, so the contract to deliver cash. There is no contract at all with the government department. Where is the contract? the financial instrument, if the Jurassic Park of financial instrument you have to enter, it will say contract. Now, where is the contract? So, statutory tax liabilities, litigation, expected litigation loss. There won't be any. So, these are all the action of the provisions of the respective statute. So, you don't have a contract. So, I and J are not financial instruments. Okay, good. Now, let me now take you to this particular question. One case study I will do. Let me do this case study. Good. Company A has purchased a debt instrument with 5 years maturity of 1000. Face value is 1250. Okay. It carries an interest rate of 4.7%. The effective interest rate of the instrument works out to be 10%. Okay. Okay, good. So, calculate the amortized cost of the instrument at the end of each year for 5 years. So, you have purchased a debt instrument with 5-year maturity for 1000. The face value is actually 1250. Okay. So, let us do this particular exercise. Okay. Now, let me take the same one here. Good one. So, what is it given to you? So, I'll make this a bigger one. Yeah, now it is fine. Let us take this as year. What does the question say? Company A purchased the debt instrument with 5-year maturity for 1000 rupees. Okay. So, what I will do, 5-year maturity. So, 1, 2, 3, 4, 5. Okay. Good. So, maybe I'll take this as amortized cost at amortized cost at the beginning of the year. Okay. Good. What is your effective rate of interest? Okay. Your effective rate of interest is actually 10%. Okay, 10%. So I'll put that percentage here. Effective rate of interest. So what is your cash inflow? Now, let me explain this cash inflow. You have a face value of 1250. So what is your face value? 1250. What is your interest rate? They will pay you only 4.7%. So what is your this rate of interest? What is your interest amount? 1250 on that 4.7 you will get. So you will get 58 rupees 75 paisa. So your cash inflow will be 58 rupees 75 paisa for next 5 years. Okay, good. Maybe 5th year alone, whatever is the balance you will get. Okay, whatever balance you have to redeem. So what is your amortized cost? You have invested how much? Company has purchased a debt instrument of 1000 rupees. Good. That is your beginning of the year. So what is your effective interest rate? You are supposed to receive 10%. Okay. So now, this is your cost. So what is your total? 1000 plus your costing is 10%. So your cost is actually 1100. But out of 1100, you receive 58.75. So how much you can amortize at the end of the year? So at the end of the year, your closing balance will be only 58.75. 1041.25. That will be your opening balance. On this again, you take 10%. So 104.13. So your total will be 1145. On that you have received 58.75. So what will be your balance? So 1086.63. That will be your opening balance. Again, I'll put the same 10% here. Percent here. This I'll put it. This entire money, fifth year I'll get 1310.59 or 1311. So this is your amortized cost at the beginning of the year. Okay. Now, company A has purchased a debt instrument with 5 years maturity. It carries an effective rating. Effective interest rate is this much. Calculate the amortized cost at the end of each of the 5 years. Okay, end of each of the 5 years. So this is what. So at the end of the year, this money you will receive back. Okay, you have invested, no? So you will receive this money back. So there is no cost. This is your cost, which you have to receive. This is what it is. So this will be your amortized cost. This is at the beginning of the year. Okay. This is the end of the year. So the question is with respect to end of the year, not at the beginning of the year. Okay. Great. So now, this is with respect to question number 33. Question number 34 is also over. Now, I'll take you to question number 26 and 27. Very important question. Okay. Please, I think we already did the 10 question. Now this 4 question, can you answer this? From out of 4, you have to choose the right answer. Which of these items is a financial asset? That means other 3 are not a financial asset. Deferred tax is definitely not a financial asset. We know, just now I explained. GST receivable is your input tax credit. Okay. It is, can you actually convert that into money? No, input tax credit you cannot convert that into. So GST receivables, I only understand this as an input tax credit, not as a refund receivable. Okay. And whether it is refund receivable or input tax credit, both are a legal right for you. So please look at that definition. This is financial asset says a contractual right. Contractual right is different from a legal right. Okay. The input tax credit you are eligible not as a contract. There is no contract with the government. There is no contract with the GST department. So that is a legal right for you based on the section. That is why it is not a financial asset. That may be an asset. Okay, not a financial asset. Gold bullion. Gold bullion is your bars. Bars, gold coins. So that is never a financial asset. That is an asset. That's a deferred tax asset, GST receivable, gold bullion are asset. They are not a financial asset. Because financial asset, it should satisfy the definition of cash, equity instrument, or another entity, contractual right. Contract. So contract to receive cash or contract to receive financial asset. Then only it is a financial asset. USD INR option held by an entity. Now, if you have an option, then you give the USD, then they have to, you give the USD, they have to give you in the Indian national rupees. Indian rupees they have to give. So you have that option to actually convert into Indian rupees future. So you have a forward contract or a future contract. Okay. So a future contract or a forward contract is a financial asset. Please understand the USD INR option. So in one currency you are able to receive. Okay, there is a contract. Okay, its derivative is a contract. So 26D. And derivative has, I told you, 3 conditions. So maybe that also let me show you what is the 3 conditions. These are the 3 conditions, guys. Appendix A. Appendix A, you have the definition of derivative. This is your derivative definition, which has 3 conditions. Derivative is a financial instrument or contract. Because financial instrument is a contract or other contract within the scope of the standard with all 3 of the following conditions. I told you Tridev, Trimurti. This 3 conditions. What is this 3? Its value will change. I normally say this as Derivative is like a male character. It's like a male. When his value changes, okay. When you are with your mother, she will take care of you very nicely. When you are with your sister, sister will love, affection will be there, the fighting will be there, and a lot more will be there. So between sister and brother's affection will be, you cannot, there is no words to say. So there, the person will be a different person. So as a son, as a brother, okay, then as a friend, maybe among friends, we take a different avatar. Similarly, with as a husband, bus. Okay, so the value will change as you take a different avatar. Okay, so that's a derivative. So we derive our plus or minus. Maybe when we are with our friends sitting in evening like this time, okay, in a very nice cozy atmosphere, the value is different. Okay, it requires no initial investment or an investment, net investment, or you require some minimum investment. So that is another criteria, and it is settled at a future date. Okay, so I always say derivative is like a male character, because their value will change anytime, and they don't bother about a big palace and all, okay, or what do you call it, as glossy dresses, attires and all, and always maybe they are futuristic. Okay, we don't live on present, we always are futurist. Okay, what we can do tomorrow, what we can do next year. Okay, so derivatives are like that. Okay, we can always relate like that. Now, which of this, that derivative definition also I have discussed. Which of this is the financial liability? uh, so liability for damages for a lawsuit, legal. Okay, it is not contractual obligation, it's a legal obligation. Legal obligation is not a contractual obligation, so it is not a financial liability. It is a liability, but not a financial liability. Tax liability is a legal liability. GST payable is a legal liability. So matter over. ACD not an answer. B is the answer. Non-refundable advance. You received an advance. Again, sale of equity instrument. So that means you have to only deliver equity. You cannot give the money back. So therefore, look at this definition of financial liability. The contractual obligation to deliver another financial asset. You receive an advance, you have to deliver equity. Okay, so that is a financial liability. So 27B. Okay. Now let me take you to another question. So please look at this particular, I think this I have done, maybe 8th one and I have not missed. 8th and 10th one I have to do it. Please look at 8th one. Very, very important question. Okay. Now please look at this. I have to take you to a definition called, yes, this definition is a very, very important definition. This is a contract. And this is a financial asset or a liability, depending upon the person who is holding it. Actually, in a guarantee, there will be three parties. There will be a borrower. Okay. There will be a borrower who has actually borrowed money. Okay. There will be a guarantor for the borrower. And there will be a creditor who has actually given money to the borrower. So creditor, borrower, and the guarantor. Three parties are there. So understand this and then answer this question. The contract that requires the issuer is a financial guarantor. Okay. To guarantor to make specified payments to reimburse the holder. Holder is actually the creditor, will hold the guarantee. Guarantor will give the guarantee to the holder for the money borrowed by the borrower. Okay. For the loss incurred because of specified debtor. Debtor is the borrower. Okay. Creditor, debtor. Creditor is a guy who has given money. Debtor is a guy who has borrowed money. Okay. So that is why the terms are very important. So debtor is a guy who has borrowed money. Okay, borrower. Contract that requires the issuer. Issuer is the guarantor. To make specified payments to reimburse the holder. Issuer is the guarantor. Holder is the creditor. Okay. Debtor is the borrower. Okay. A contract that requires the issuer to make specified payments to reimburse the holder. Why reimburse? He has given money to debtor. Debtor didn't pay. Then issuer will make the payment. To make payment when due in accordance with the original or modified debts of the debt instrument. Bussu Govinda. Okay. So now answer this question. A contract that requires the issuer to make specified payments to reimburse the holder for a loss it incurs because the specified debtor fails to make a payment. That is hedging, contract, financial guarantee. Remember, guys, financial guarantee is given by guarantor. To whom? To the creditor or to the holder. Now, for giving guarantee, there is a present value of that guarantee contract. That present value of the guarantee contract, there is a payment has to be made to the, whether a guarantor will sign as such, no. Guarantor will not sign. Guarantor, there is a cost for the guarantor. You need to pay the cost. Now, what is that cost? In present value, you have to pay. So there is a working for it. There is an arithmetic calculation for it. Your Indian accounting standard doesn't prescribe the mathematics of working, but it prescribes that there is an amortized cost for it. Okay, there is an amortized cost for it. Using the effective interest rate, you have to calculate that. Okay, very important. So that is why this entire standard, Indian Accounting Standard 32, 107 and 109, all the three standards, it is not, no, it is accounting standard. I know accounting, debit, credit, I will actually manage this standard. No. It is not only accounting knowledge required. You need the knowledge of financial management. You need to know the skills of the various financial tools, okay, to actually appreciate the arithmetic, how it happens. Most important, you need to understand the business. How in finance world, the financial instruments are used or documented, generated, contract is entered, and contract is satisfied or cancelled. So that is most important. So accounting is very, very simple or straightforward. But provided you appreciate the contract, you appreciate the business, you appreciate the arithmetic involved in it, accounting will be the simple thing. The Indian accounting standard will be the simple. I'm telling you. Now, answer this question. Yeah, 8C. Okay. Now, last but not the least, I'll just come to this P 5.4.8. Yes, this one, guys. Yes. There is a transaction cost, because transaction cost will be included in your effective interest rate. So transaction cost includes fees and commissions paid to agents, advisors, brokers, etc. Yes. Then levies by regulatory agencies and exchanges. Okay. So that will also transaction cost, which you have to include in your effective interest rate. And your transfer duties and taxes, if at all any, maybe, because every GST is applicable to finance transaction. Please understand, 18%. So that also will be there. But they have specifically excluded that do not include premiums and discounts. Okay, internal administrative holding cost. So generally, there will be some discount that will be given on the transaction discount. That is actually for entering into the transaction between two. So the debt premiums or debt discounts are not transaction cost, for your information. Okay. So 10D. So guys, I'm sure tonight you will have a very good sleep, because we had a mega marathon session with respect to financial instruments. I will just invite 3 of you. Please be there I'll just invite 3 of you to give your feedback before we close for the session. May I request Suhas Kumar to kindly give your feedback, please? And I'll also request Ramalingam to share your thoughts, Mr. Ramalingam. And we'll also request Megha Mittal to share your thought. And I'll also request Jayashree Vinnakota. Yes, Mr. Ramalingam. Absolutely
Sir.
clear and well.
Good evening, sir.
Good evening.
I think hope your health is fine. I think it was an excellent task. Yeah, it's an excellent session, sir. Actually, by the way, I am Ramlingam. I'm working for an MNC. I'm heading finance. I think I never missed your session because even at the tight schedule, if we could spend this 1 or 2 hours time listening to your lecture, I think we get a lot of inputs and we have been able to know how to understand the concepts at the same time, how to face the exams. I think with this wonderful motivation and confidence, definitely we think that we will try to complete the certification course successfully. Thanks a lot, sir. Thanks a lot for the great support and guidance and motivation, sir. Thank you.
So nice. Our best wishes. And let us now hear from Jayashree. I think you are live now.
Sir, thank you so much for helping us to understand all the important aspects of the standards. It is not only helping us in specifically understanding the standards that you have taken in the session, but the overall understanding or how to approach any accounting standard. And extremely thankful, and it is very happy. Whenever we attend your session, we feel our knowledge and understanding enhances, and we feel very confident. And all the material that you are providing us will supplement and reinforce our understanding. Thank you so much, sir.
Welcome. Our best wishes. And let us hear one more from Adi Narayana. Can we hear from you, Mr. Adi Narayana? Adi Narayana, you can unmute and share your thoughts. Very good evening.
Good evening. It's an excellent session, and you have explained the nitty-gritties of financial asset, financial liability. And see, actually, these terms look very easy for us, but when it goes to a definition, it's very difficult to understand. But you have unraveled that mystery with your examples. So we are able to understand the financial assets definition and the financial instrument, all those things. And by the way, with your assistance, you have cleared a valuation exam also long back. I hope doing this also now. Excellent session, sir, especially on financial instruments. Sir, please share this material along with the Excel sheet.
Yeah. Tonight I will send to Sarpa. He will share it to everybody.
Thank you. Excellent session once again.
Thank you. One more, maybe we'll hear from Mr. Avadut Mulye. Avadut, you can unmute yourself. We are not able to hear. We'll hear from Bapuchi Rajagopalan once again. Mr. Bapuchi Rajagopalan. And last but not least, we'll hear from Nainesh Sangvi. Nainesh Bhai, we'll hear from you also last. Yes, Mr. Bapuchi Rajagopalan. You can speak now.
Yes, sir. Good evening.
Good evening.
The thing is, with your support, I just have given this mock test last week and able to clear that.
Oh, very good.
So that gives me the confidence, and with this, I think I can do well in the actual examination. Thank you, sir. Thank you for your support.
Excellent, dear. Excellent. So nice. Our best wishes to you. So we'll now hear from Mr. Nainesh Sangvi. I'll now unmute Mr. Nainesh. Yeah. Yes, Mr. Nainesh, you can give your closing remarks. Maybe it's rotating. How about Mr. H. Srinivasan? Can I request Mr. Srinivasan, please? No, okay. Maybe all of us are very tired. My sincere wishes to each and every one of you for your examination. and have a great time, and take care of your health and also your friends and family. Okay, thank you very much. Best of luck.